Rajat Bhattacharya has promised us with us. He's Senior Investment Strategist at Standard Chartered. He joins us now. Rajat, good to have you with us here. If you were a betting man, would you say the CPI will confirm that inflation has peaked and markets rally? What's the probability of that happening?
Morning. Yes, Prashant, CPI has clearly peaked. We've seen the peak probably in the middle of last year, right? But the thing is that how far lower will it go? I mean, that's the key question. So tonight, obviously, you know, the consensus is expecting 6.5% on the headline and 5.7% on the core CPI. Now, any misses, and we've been seeing downside misses for the last few months, any further misses are likely, and that's going to prop up probably the markets in the near term. But I think just the watch on CPI is not going to be enough to call the market. Basically, what we're seeing elsewhere is the slowdown, decisive slowdown in US growth. You mentioned ISM services earlier. That was a shocker, actually. The market was expecting 55, which is a pretty solid level, which was holding up. The services sector, as we know, was holding up the US economy. But it came in below 50, and that's a big shock. So that indicates that the US economy is getting closer to that recession level. And that is worrisome. And so you could see the market bounce because of any downside misses in CPI, but then the overall economic, the recession story comes into play, and you then have the earnings coming through. So we need to wait and watch for those earnings numbers very closely.
All right, so there's a decisive slowdown expected in US growth. Got that. That seems to be the common narrative. Rajat, good morning and Happy New Year to you. Let's talk a little bit about the other big narrative, right? The China reopening and the fact that foreign investors could be scrambling to put money into China, considering valuations are on the cheaper side. Do you see money moving out of India into China, or is that too simplistic an argument right now?
Good morning and Happy New Year, Sonia. And yes, I mean, scrambling is the right word. I mean, we've been talking on this platform for a few months, right? And we've been saying for last few months that we need to be in China because of the rock bottom valuations. When you talk about China versus India, clearly India was the outperformer last year, and there was scope to take money out, take some profits out of India. And that's also playing through in the market. So you mentioned if II is taking money out, that's rational. If they've made a huge profit and they're overexposed to India, they might take some money out and put into China because China valuations are still, attractive, and it's been beaten down severely. But structurally, India remains, one of the strongest stories out there. The growth, for instance, is clearly there. China, of course, is likely to outperform in the coming quarters. We had put a growth estimate of around 5% growth for China this year, and that is being revised higher. I mean, we'll go into another meeting pretty soon, but we see that the growth expectations, I've seen credible independent houses talking about 7 to 8% growth in China this year. That's pretty solid acceleration in growth, and equity markets will probably follow. So there is tactical scope in China, but structurally the story is still bullish in India. So overall in allocations, I would say that if you're overexposed to India, the key word is overexposed to India, then it makes sense to take profits in India and invest elsewhere in Asia. We are overall bullish on Asia, but structurally there's no reason to sell if you're just in the right sized in India.
Hi Rajat, morning. A couple of points out there. As you were saying, you believe the inflation is nearing the peak zone, I think so. But if China is going to do well, a lot of these commodity costs suddenly are going up. So, that could be a risk, right, to inflation cooling down as well.
You're right there, but the thing is, you need to see what is driving this China growth. So for the first time, I mean, the main difference in China's reacceleration this time, Nigel, is that it's going to be consumer-driven, it's domestic-driven. China has always accelerated because of investments. But this time they have a challenge in the local governments are fund strapped. Because the property market is down. The core area where they raise funds is through land sales, but they are stuck there. So investments as a result is not going to be that significant a driver this time. It's the domestic consumption. And we've seen that, how in economic reopenings after COVID, we've seen the same story come through in India, in US, in Europe. Why not China? So China is going to play the same theme. So it's going to be consumer driven.
Sure.
And then the inflation's fallout is going to be probably limited. We've seen copper rise. You've seen the surge in copper, and some of the currencies that are exposed to those kind of metals, materials like Aussie dollar has gained. But the fallout from China to the rest of the world in terms of inflation is going to be limited. It's more going to be consumer-driven story in China.
All right. Just one final question. If you can, since you're an investment strategist, there is this whole theme playing out about how equities could take a backseat this year, and commodities like gold, which have been a great hedge against inflation, could perhaps come back into the forefront. Would you advise putting a larger chunk of money into gold versus equities this year?
We are neutral on gold currently, but if the dollar breaks structurally, the dollar has come off from, dollar is the other one that has peaked other than US inflation. But it's testing a structural, that 200-week moving average. That's what it's testing. If it breaks lower, there'll be a structural break. And if the dollar falls and the Fed pauses at some point later this, probably sometime in the first half, then there's a story for gold for sure.
All right, we will leave it at that. Thanks a lot, Rajat. Have a great 2023. Hope to speak to you very soon. That's the word coming in from Standard Chartered, where they believe that there is a decisive slowdown in US growth that's expected later this year. Global investors may move their money out of India and into markets like China, although he is overall quite bullish on the Asian markets, despite all the volatility that we're seeing globally. Let's slip into a quick break. Our list of top stocks is lined up in just minutes from now.